borrowing, enhancing our profitability. This leads to higher valuation of the stocks, ETFs like SPYG, which focuses on returns, okay, and growth, which is a very, very nice fact. Okay, this adjustment on interest rate sometimes would actually change our the volatility and the potential for high returns. Okay, so sometimes if the Fed goes about saying they will decrease the interest rate, they will stop decreasing the interest rate, sometimes it may send market shocks and the market might be a bit volatile. Okay, so now today the first ETF that I'm going to overview is the SPYG ETF. Okay. So as we can see, the SPYG actually has some volatility, right? Before the interest rate was confirmed that it is going to go down by 0.5%. This is the prices like 1 or 2 days ago. Okay, but today it actually went up to $81 after the good news of the interest rate coming down by 0.5%. However, today we are going to learn a strategy about how to combine a covered call strategy, right? How to combine a covered call strategy with owning the SPYG. So, for example, Singapore Puppy owns 100 shares of stock X. So, if the price is priced at $100 and he sells a call option of, while he owns the share, he sells a call option of 90 days at $100, you take a premium of $3. So, within this 90 days, there's a premium of $3, which means is actually we have a, okay, if it means that we have $3, right, it means that we actually have a good return. Okay, we actually have a good return of 3%. Okay, so if the stock stays below $100, we will manage to keep the $100 shares of the stock and also the premium of $3. We will make a very good 3% returns in 90 days from the premium. Okay, so I will include the SPYG covered call strategy. Let's say my price is of the SPYG is below 80. So the current price is about 80.40, which is almost like yesterday. So if I would buy a 100 shares of the SPYG, right, and I would sell a call premium of 32 days, I will be able to get $2 of premium. But the $2 of premium I add on to the subtracting the 80.40, my cost will be 78.20. So having a 78.20 cost, but however I'm able to sell off the strike price at around $80, right? So I will be able to earn $1.80. I will be able to earn $1.80 of the capital, which is around 2.5% of the total capital. Okay, so it's pretty good. So when we after we own 100 shares, we can actually sell a call, okay, and adjust the strike price that we are willing to let off our shares. So once we let off our shares, we will get a premium of we will have to sell our shares at $80, okay, and we will get the premium. So about 2.3% of profit. Okay, pros and cons of selling a covered call on SPYG. Okay, some of the pros we have is effective when the investors expect the SPYG to trade within a range. Okay, it will benefit from steady or slight increasing stock prices. The premium collector offers immediate income. This limits the upside potential of the investment. If the SPYG prices rises significantly above the strike price, the shares will be caught away. Okay, so some of the cons are the investor might miss out on further gains. So let's say if I were to sell the call option at $80, okay, the maximum profit, the maximum price that I could sell is 82.20. However, if the price of the SPYG goes up above 82.20, I will be missing out any potential gains. Let's say if the price of the SPYG goes up all the way to $84, I will miss like about 180 of potential gain. Okay. So next we will be going through TLT. TLT is a 20 plus years treasury bond, which tends to have sensitive changes with the interest rates. So TLT provides a stable incomes of monthly dividends. Okay, so on the right we can see the history of the TLT dividend. Okay, the history of the TLT dividends pays like about 30 cents per month, which is pretty nice. So the overall overview of TLT. So as we can see, at 89, 89, 82 price at the lowest point, right? At the lowest point, the interest rate was the highest. However, when there was a signal since someone last 2 months ago, when last 2 or 3 months ago, when Fed actually signals for the interest rate to fall, TLT has been steadily increasing with the promising decrease in interest rate. So TLT has actually recovered all the way to $100 due to the lower interest rates. However, we can also include the selling of the call option strategy to earn extra dividends or extra premiums on top of the dividends. What I have here is a picture showing the call option on the TLT. So to maximize the returns on TLT, not only I will be receiving the dividends monthly, I can also, if I own 100 shares of the TLT, I can also sell a call premium. Okay, I can also sell a call option, which is a covered. This will makes it a covered call. So I will be selling a call option, promising the counterparty that I would sell the 100 shares to him if at any time he wants to buy it. So if I have my cost of TLT at $100, I could sell a call option of TLT at $100 or $101. Let's see, for the $100, I would get let's say I sell the call at $101 or $100, I will get a premium of $3 plus to $4. So I will get around 4% of premium for 106 days. In addition, I would also get the dividends. So in 100 days, not only I will get the premium from 3.6%, I would also get some I will not only I will get a premium of 3.6%, I will also get a dividends of monthly around 0.1 or 0.2% each. So it will mix up to be 3.6%, which is pretty good. So however, if TLT price exceeds the strike price of $100, the share may be caught away, limiting further any potential gains. So this strategy can be particular use. Okay, this strategy can be particular use when we want to maximize our potential gains, and if we think that TLT is going on a range bound. Like yesterday, TLT actually falls a bit. So if I would buy TLT at $100 and I sell a call premium of $3, my cost price would be technically within this 100 days, my cost price will be $97. So I still have a $3 of buffer for TLT to drop. So at so now TLT is around 99.9. 90 cents. So I would have a 290 of buffer for TLT to continue to drop. So my cost price is from $100, it has becomes $97 after selling the call option. So next, I would also go through another very interesting ETF is a covered call ETF. So this is managed by a fund house. What would they do is they would take our amount we put in that invested in. They will take the amount that we invested in to buy stocks and sell covered calls. So this ETF is very, very interesting. This ETF actually help us to do the whole process themselves without us knowing how to do the process. So it's particularly good for someone who wants to enjoy monthly dividends but not having the hands-on of selling the covered call themselves. So on the chart, it shows the volatility of the QYLD. However, what is an even bigger bonus is we can actually sell a covered call on this covered call ETF, earning extra premium. So the dividend for this covered call ETF is around like 17 cents monthly, which I will show you later. But so the strategy I involve is I will buy QYLD at $18 and I will sell a 30 days covered call. So it will give me another 12 cents to 15 cents, which is near to 0.7 to 0.8% on top of the QYLD call premium. However, I bought this QYLD slightly lower, about 1790 plus. So I would also be getting an 8 cents of extra potential gain. Next, we will be going through the consumer streaming entertainment sector. So consumer streaming entertainment sector, some of the most used one are the Netflix and the Disney Channel. So interest rate has been lowering. So lowering of the interest rate has led to consumer having more money to spend on entertainment and leisure activities, benefiting streaming companies like Netflix and Disney. Netflix and Disney company would have offer entertainment, and people have more when the interest drops, consumer will have more income to spend on. So having more income to spend on, they can, beside basic necessity and needs, they can also have some leisure activities. So they will most likely there will be more subscriber for Netflix and also more subscriber for Disney. So this will generate a greater revenue. So on the next slide, I will show the Netflix stock analysis. So since the drop of the interest rate, since the signaling of a drop of the interest rate, the earnings of Netflix has been going positive for most of the months. As we can see, the last quarter it actually has a estimated earnings of 474, but the actual earnings actually beat the estimated earnings by quite a lot. So this provides a more revenue for the company. So having more revenue for the company, this will lead to a positive effect on the stock price of Netflix. So this will lowering of interest rate will boost consumer spending. So I'm giving an example. Okay, so on entertainment services such as Netflix. So Disney is also the same, but Disney on top of the basic streaming entertainment, they also have various places like entertainment sectors, including theme parks, services, and also the Disney cruise. So Disney's earnings will be affected, will be positively boosted by the lowering of interest rate. So this enhances the returns of Disney's shares with the covered calls. We can also sell a covered calls on Disney to enhance the returns. So let's say, I would think that Disney will range bound between 90 to 92. So I would sell a covered call on Disney at $92 of 46 days and earning about $3 of the premium every 46 days, which is pretty good. I would say around 4% of near to 4% of returns on the premium. So, but however, we also have to take note again, if Disney goes above the price of 92, our 100 shares of Disney will be caught away. But let's say if Disney stays at about 92, 93, we could still buy 100 shares of Disney, and we could cycle this strategy. However, if Disney share price remains below $92, okay, the call option will expire worthless. And as a call option seller ourselves, as an investor and a call option seller ourselves, we will be able to keep the 100 shares of Disney, and also we will be able to keep the full premium. So for investors that expect Disney price to remain stable or increase slightly while generating extra income, we can sell a call option. So next we have the travel industry overview. Okay, so like AGXM, yeah, today I'm not going to talk about Palantir. Maybe some other days I will talk about Palantir. Thank you for the reply, the comments. Okay. So the travel industry includes Royal Caribbean, which is significantly influenced by economic conditions and consumer spending. Lower interest rate can stimulate travel demand by making vacation more affordable and boosting discretionary spending. So Royal Caribbean is our leading cruise operator. It has positive earnings and revenues for the last few quarters. Personally, I also like to see this. So in the terms of value investing method, so this is a company that is in my portfolio. Okay. So, but sometimes I will also want to earn some extra premium on top of the dividends paid by Royal Caribbean. So I will also sell covered calls on Royal Caribbean. So I give you an overview. So we can see Royal Caribbean stock has been going up and down. Okay, but overall, when the interest rate we okay, when the interest rate already we is given that is lowering, the Royal Caribbean stock went up from a low of $130. So we have the stock analysis. So that Royal Caribbean kind of produce a semi-annual dividend of 40 cents, which they kind of promise, or we kind of predict. The last, so this is the first dividend of 40 cents given since a very long time. Before that, they have stopped given dividends due to the COVID and due to them spending more money on expansion and buying other ships and renovating their ships. So for Royal Caribbean actually pays a very, very nice dividend. So we can see if we are selling a call option at $170, we will get a $13 of dividends. So it's around 94 days. So this is pretty fantastic dividend that I just not dividend, pretty fantastic premium that I just realized. Okay, so the premium is pretty good, $13 for 170, and have some potential gains of 24 cents. So this is something I would do if I own 100 shares of Royal Caribbean. This is one of the better premium stocks that also gives dividends. Okay, next we will go to Singapore REITs overview. Singapore REITs is uniquely in Singapore where we have all the malls there. So hope uh, viewers of other country can also come to Singapore to have a look and experience how our malls is like. So in our malls, we actually offer a investor, right, a way to participate in real estate investment. Okay, so participate real estate investment. So in a low interest rate environment, our REITs is able to pay 5% of year annually because it actually takes the rental from our all the retailers. Then for us, we will park our money with the Singapore REIT. Then the Singapore REIT will rent a place. Then the place they will rent to retailers. And when the retailers pay more than what is their loan, we will be able to get dividend as nice as 5% yearly. So today I will be going through one of the REITs I own, which is Capital Land Intercom. So Capital Land Intercom gives quarterly dividends, which is quite nice, around 5 cents. And what is good about Singapore REITs is our Singapore REITs is non taxable. Okay, our Singapore REITs is non taxable, so is pretty nice. Okay, so being non taxable, our Singapore REITs is pretty nice. So it gives about 5% overall dividend. So it gives about 5% overall dividends. So as the news of interest rate going to fall, the Singapore REIT has like Capital Land Intercom has been rising steadily from 180 to 220. So we also have to have some risk management in the rural environment. So sometimes we have to spread our risk across different classes and assets, which I showed last few slides. So I have today I have go through an overview of all the assets that we have. So like entertainment, then we have some REITs, then we also have some bonds. So this will actually cushion any sectors drops, okay, and adverse market movement. And also selling a covered call, I always say you give some additional income and add some share to what we have. Okay, so selling additional call actually is pretty good in that sense. Okay, so we will explore more risk management techniques and how can they apply to maintain a balanced portfolio. So impact of interest rate changes on some income investment. So we can sometimes we can use study past the history to see how would interest rate moves according with our ETFs like TLT and QYLD. So for the interest rate increase, right? It actually when the interest rate increase, TLT goes down. When the interest rate increase, the TLT goes down. But when the interest rate decrease, TLT actually goes up. So this can lead to price appreciation for ETFs like TLT because which are long-term bonds. Long-term bonds become the price is going up when the current interest rate drops because the interest coupons for the long-term bonds are actually locked in. So covered call ETF also benefit from interest rate through higher years of option premium. Okay, so but in a low rate environment, right? So it's a substitute for putting it in a fixed income like money market because if the interest rate is coming down for money market or coming down for government short term government bonds, right? So now it's around, for money market is around 4 or 5%. But if the interest rate comes down, the money market will come down. So QYLD actually provides like about 1% per month. It might be and about 12% per year. It might be a more attractive vehicle for us to park in compared to fixed income. However, there's still research involved. So investors should also evaluate the impact rate of changes, so we can learn ourselves also, and we can see charts and relationships to make a decision. So strategies like selling a covered call enhances the return in a low rate environment, while long-term bonds also offer a stable income because it already lock in their prices and also provides capital appreciation. So for long-term bonds, we will talk about TLT ETF performance. Okay, so this is a recap of TLT investment. So at the lowest of the TLT is when May, okay, when the interest rate is the highest. So TLT actually falls to $89. Since the signaling of the interest rate drops, TLT has been going up steadily. So usually, if a vehicle, sometimes they give dividends, the ETF will fall. But we can see because of the market projection, TLT has actually locked in the interest rate of 3% plus per year, because the long-term bonds lock in 3% plus of interest per year, and we are projecting that the short-term lending rate may now is 4.75 to 5. It may further fall even down lower and lower and lower to 2%. So this might be a more attractive asset. So this lead to a strong push in the recovery of TLT. Next, we also can see the SPYG performance. Okay, so SPYG is quite volatile because what it has inside, there was a slide that I showed, consists of all the big eight like Microsoft, Meta, Nvidia, and Tesla. All these are inside SPYG. So, and Google also. So as interest rate falls, some of these companies have actually borrowings to expand more. So if interest rate falls further, they might borrow more to expand more. So they will be able to expand more, leading to more revenue. As more revenue, the projected rise in the asset values of the various stocks inside this ETF will rise too. So this case study here illustrate that a signaling of the fall in interest rate leads to a rise of SPYG. As we see in the diagram, we see 5 green candles. Green candles means is bullish. That means it has been rising steadily for 5 days since last week, when Fed Powell said that the interest rate is coming down. Next, we will see gold ETF. Gold ETF. So there are a few ways that we can buy gold. We can buy physical gold, we can buy gold future, or we can buy gold ETF. For me, gold ETF is still the best because it provides a lower entry price, and it also is the fees involved compared to buying physical gold is lower. So gold fluctuation is also linked with the interest rate changes. Because in low interest rate, one may think that gold will appreciate more than what the fixed coupons of lower coupons will be given. So this pushes out the bullishness of gold lately. However, so what comes up may have to fall down, right? So sometimes I would think that some days it will fall, some days it will be up. So gold might be on a range because it has actually reached new highs already. So before it break another high, it might have a small range. Sometimes I will also include the selling covered calls on gold ETF. Including selling covered calls on gold ETF benefits the the owner of the 100 shares of the gold ETF. So what I would do is I will sell a 36 days covered call of gold ETF at $48, having a premium of 1.1. This generates about 2% of returns. So this is what I would do. Here it says that I can sell it at 48 or I can sell it at 49. Let's say if I were to sell it at 49, I have an additional of 30 cents potential gain. As we can see, the top part, it shows that the price of current gold is 48.70 and the new gold, the strike price of gold is $49. So there's a 30 cents of potential gain for the gold to go before I have a contract obligation of selling it at $49. So in addition of the 30 cents of potential gain and the 91 cents of call premium option, selling call option, getting the premium of 91 cents, I would have a total gain of 120 if gold were to go above the price of $49. Sometimes I would overweigh getting premiums and potential gains over the max potential gain I can get. So the max gain I will be able to get from this trade of owning the gold ETF at 48.70, then it will be to $49 will be 30 cents. And from the premium that I'm promised and I lock in already is 91 cents. This also lower my gold purchase price to $47 plus. So this strategy is good when there's a moderate increase in gold, which I would think that it might happen. So risk and consideration of selling gold ETF, covered calls on gold ETF. So there are certain risks and considerations to keep in mind. One risk is when the gold price goes significantly up above the strike price. So as an investor, we might miss on the potential gain above the strike price. So for example, if gold go to $55, but the maximum price that I can sell gold is $49. Another consideration is the impact of price volatility. If the gold price were to fall below quite a lot, to 45, I would actually make a loss. So we might have capital loss that is beyond of the premium. So always our capital management is still very important when we are employing this type of strategy. While selling covered call can enhance income, right? However, we still need to have our own views on how would the asset behave. So integrating the IAU covered call into our investment strategy, right? Okay. So we can have several hedge against inflation and economy uncertainty. So gold is, in the past history, gold has certainly do quite well in economic crisis or that. So this actually, the IAU gold ETF actually serves as a hedge, serves a hedge to having other assets classes. So we can adjust our strategy about options. This makes options very interesting. So we have effective portfolio management strategy, like I previously said. So we have some fixed income from TLT, then we have some hedge against if there's any economy downturn. Okay, we have gold also. But what if there's no downturn and there's no then the economy will go up and up and technology will rise and rise, right? So we also have certain growth stocks for capital appreciation like SPYG. And we also have ETFs that helps us to gain the core premium dividend like about 1% per month from QYLD if one does not wants to do the core strategy by ourselves. So regularly reviewing and adjusting our portfolio, right, based on interest rate and changes on market conditions is essential for maintaining a well-balanced and resilient strategy. So in conclusion, interest rate has been going significantly up and down, right, for various sectors and investment. Understanding these effects, right, helps investors to make informed decisions and optimize their portfolio. So we have explored how low interest rates on growth, okay, like specifically like SPYG, TLT, and QYLD, this has been going up due to the lower interest rate that happened yesterday. Promising on, okay, so we take note now a 50-point decrease in interest rate. Okay, it might be a soft landing. Okay, so we could also they could also adjust a 50-point change. Okay, so that can stimulate growth. Like Powell say that a 50-point is needed to stimulate growth. There's a need to, and because there's a lower of interest rate and okay. So now we have our Q&A, right? Okay. So once again, we have a Q&A, okay? So Q&A. So we have our Q&A today. What is the primary purpose of iShares Gold ETF, IAU? So anyone can answer? So A, to track the performance of silver bulletin, to provide exposure to gold, to invest in technology stock, and D, to S&P 500. So this is the Q&A. So okay, BR. Okay, Lawrence SG is correct. Okay. So what does a 25 points decrease in interest rate typically signal about the economy? Okay. So what does a 25 points basic interest rate signify about the economy? So so the economy is A, B, or C? Oh, okay. So this one might be okay. Okay, C is okay, good. C is correct. So in a low interest rate environment, right? Which of the following sectors? Okay, give me a moment. Let me change it to okay. So in a low interest rate environment, which of the following sectors is benefit most? Okay. So can you tell me? I will read it out. Okay. Utilities, financial, technology, or healthcare? Okay. Yes, it's technology. Okay. So next is our last question. Yes. CC Lim actually win, and also Lawrence SG win. Okay. Yeah. True. Yes. So the next. Okay. So the next one, right? What is the key associated with selling covered calls on IAU? What's the key risk on selling covered call on IAU? Question 4. Okay. Okay. So CC Lim win again. Okay. So today, Sylvan Roy, CC Lim, and Lawrence SG, and okay, Tiger Hawk each win one of the pair, right? Okay. So the premium received may not be sufficient to cover potential loss. Okay. So as we revise, right, the premium, okay, the shares may be caught away if the ETF exceeds the strike price, limiting potential gain. Okay, once again, the opinions, strategies expressed by the speaker of this video is not is of this video is of the speaker and not Tiger Brokers. This is the disclaimer. Okay, so and okay, not Tiger Brokers is not liable. This is advertisement has not been reviewed by MAS. Okay, so won so many. Okay, so you have to, oh, okay, wait a minute now. Okay, so okay, so you can okay, sorry, so you can contact Tiger Brokers, or you can contact you can contact the captain Tiger Trading View. Okay, okay, so we can look at some of the call options we do. Okay, so especially we can see the call option, how I go about the process that I do it. Okay, can, so we can see here. Okay, we can see here the QYLD, right? Okay, let me shift I try to shift the screen bigger, so that you all can see. Okay, so okay, can, so I already shift the screen bigger so that you all can see. So we have here QYLD, right? So I have some other strategies that I incorporate into QYLD. So QYLD, actually what I did, right, was I bought some shares at QYLD at 17 plus, which is a dollar averaging. Then I also sell a call premium. So on top of like earning the premium, right, from the QI, on top of earning the dividends from QYLD, I also earn a call premium of 14 cents on QYLD when it expires. However, there is a risk that my QYLD might be caught away. Okay, so also my QYLD put, I have been selling QYLD put monthly, as we can see here. So options is actually very interesting for like we go on to, so some of the functions of how we can track our returns will be, we can go back to the QYLD. Okay, so as you can see, we can track our returns. That I have been dollar averaging of QYLD every now and then. Okay, then we can also go to our overall profit and loss pages. Yes, Hua Xiaojie, you can listen to this later again. It will be pinned up on the live site. Okay, so some of the core, some of the premium that I sold for QYLD that I get is here. Okay, as since 2003, right? So we can see, I scroll in, right? So since 2003, I have been selling put options on QYLD at $20 at, okay. So on top of this, I have been getting regular dividends from it. So about a few $100 already on top of the premium. Okay. Some of the other stocks that of the other various sectors that I did not include is my benefit is like insurance company. So we can see insurance company, we also have like many sold many options of put options, and also sold many call options of the above. So as we can see, as Manulife, right, increase, but at the current Manulife is a bit higher, so I have stopped this strategy, but I might reconsider like using this strategy once again on Manulife. As you can see, this is Manulife, right? I have actually earned quite a lot of premium from selling calls and puts on Manulife. And this profit does not include the dividend we get. On top of the dividend, I would certainly earn more from Manulife. So sometimes we can use this strategy on. So how do I actually pick what stocks, what counters to sell a premium on? So we can see some of the learning strategies is, so if we sell on some mini stocks, sometimes it goes up and down. Those are most on customer on the market sentiments. However, if like stocks like counters or assets like um financials, we can go to see the earnings. So what actually affects the prices of stocks is a lot based on our education that we learn is based on earnings. Earnings has been quite regular for insurance company like Manulife, Prudential. So I think is a asset that we can sell call option and put option on it, which is pretty good. Okay, asset to do that. So what we can see is from the graph, right? We can see the earnings. The earnings has been regularly changing, right? So and also the revenue too. Okay, the revenue has been steadily increasing also from quarter to quarter. What's so good about Tiger app is quite is very good to scroll, and we also can adjust earnings from the annually or the quarterly. So it will also give us the estimated earnings from analysts. Okay, so some of how I identify which stock to sell a covered call. Usually I use the financials to help me. Then I will scroll down on net income. Sometimes I will scroll down on operating income. Okay. I will also slow down to quick ratio. Quick ratio is how quick the company can change. Okay. Can change itself. And of course, earnings per share once again. Okay. So financial analysts, we scroll down the earnings per share, we can see all, okay, or we can see annual also. So we can, yeah. Except for the COVID year, it actually went down a bit, maybe due to more claims. But most of the years is quite stable. So on the COVID year, actually, I own like Manulife, but I I I didn't really I didn't really release it, but I sell a call option on it. So I get premium on top of the price drop. Keep on selling. Sometimes as I keep on selling call option, my positions that have negative actually turn positive after time. It's like it's like how human work. Sometimes if someone hurt you, you also can like hear through time. So if price drops, also we can hear through time. Okay. So some of the other users of the Tiger app is very good because okay, because we have it shows what is the where is the company based in, then we can know of certain history, all this. Okay. So okay, so when let me talk about history on the past few of my life. So you remember when I say Sophie. So Sophie at one time when I started on Sophie, I actually on the first video on Sophie, I actually have a profit of Sophie for 100 plus, right? So as there was a week that is quite red and the market is a bit a bit negative, my Sophie stocks and the options actually went down to a negative of 100. But however, if you put in time and you let the option decay, right, while owning the stock, okay, um, the time will decay the premium of the option if we are selling it, of course. Not I don't really buy options unless I'm always will sell an option before I buy it back. So for Sophie, I do that and it turned out well. Okay. So some of the premiums can be as so for those negative one, usually I do not I have yet to close them. Okay. So some of the other strategies that involve in options is we repair the options as the maybe when the stock drop to a certain price, right, and we are feeling like a bit scared. Okay, sometimes I as long as I feel like I break even over a period of time or I earn a bit, I will take the strike price, adding the premium price and adding the previous profit that I closed from another call option, then we will be able to make some good profit. Okay. Thank you, Hua Xiaojie. Okay. Yes. This will be recorded. Okay. You will be able to hear it later too. Okay. So so these are some of the various insights of okay. These are some of the various insights of the of all the interest rate that I'm saying today. Okay. So okay, so I actually okay, so we can go through some of the other more okay, we can go through some of the what we went through before and do an overall summary. So in case if anyone wants to ask the questions, right, you can uh message on my post on on all the posts. Okay. And also do remember to like our okay and to remember to like Tiger Trading View. Okay, like Tiger Trading View, which I will put on the comment below. Okay. So for those that sometimes they win the prizes, right, and then they could contact. Okay, Tiger Trading View. Okay. So for those that so I'm here, Tiger. Okay, Tiger Trade. Oh, it was a typing error. Okay, can. Okay, so you all can also go to like and subscribe Tiger Trading View. She will this is a admin staff which will update certain good live streams and also handle the context of all the winners sometimes. Okay, so thank you so much for today, and we will see each other soon. Okay, hope you all enjoy and like the video of the today live stream, and also do subscribe to my channel and do subscribe to my okay on Tiger. Okay, then if you all have any questions or to ask, usually on various things that I do or on my live trades that I regularly regularly post, y'all can comment on the below section. Then I will try my best to answer. Okay. So hope you all have a good day. Okay. Thank you. Bye bye. Hello. Hello. Hello.